You know, in this business of speculation, most folks want a shortcut, a magic signal, a promise that something out there will save them from their own impatience. But trading doesn't work that way. It never did. Today I want to talk to you about trading breakouts using pure price action. Nothing fancy, nothing artificial. And before we go deep, let me tie it back to something familiar, just like we talked about in the previous video on dangerous illusion of easy trading. The market will always reveal the truth, but usually only after it has taken enough from those who believed in easy answers. Now, breakouts, what are they really? People like to call them opportunities. But opportunities only exist for the trader who knows how to watch and wait. I used to sit for days, sometimes weeks, studying how price behaved just before it burst out of a range. That's where the real tell was. The amateurs chase the moment of the breakout. The professionals study the conditions leading to it. Ever stop to ask yourself whether you're chasing or studying? A breakout is nothing more than the tape announcing that a stock or a market has found enough power to leave its old level behind. And price action, raw, honest movement, will tell you everything you need to know if you're willing to watch without guessing. Most traders can't manage that. Their minds get in the way. They predict, they hope, they fear. The market punishes each of those sins without hesitation. Have you noticed how expensive hope becomes in a sideways market? Before a breakout, price starts to compress. The swings get smaller, the volume steadies, and the whole thing feels like a spring winding tighter with every bar. You don't need a fancy indicator to see that. You just need patience. The kind that doesn't twitch when nothing's happening. I used to spend more time waiting than trading. That's the part most people can't stand. They think waiting means doing nothing, but waiting with intention is the most active work a trader can do. Doesn't it feel strange how your hands want to act while your mind knows the right move is to be still? When price finally pushes out of the range, most traders jump right in. They buy at the exact moment the professionals are testing the water. If the breakout is real, you'll often see a clean push, then a calm retest. That retest is the market asking you, are you sure you want in? And most folks answer too loudly, too quickly. But if you watch carefully, you'll notice that real strength doesn't panic on the pullback. It holds firm. It refuses to dip back into the old range. Have you ever seen that kind of price action and felt your pulse quicken because it looks too obvious? But the market doesn't reward the obvious. It rewards the prepared. Trading breakouts with price action means waiting for the story to make sense. If a market breaks out but does it with wild, erratic behavior, that's not strength. That's noise. Strength is steady, almost boring. The best breakouts don't shout, they whisper. And only a trader who has learned to read the tape without emotion can hear them. Ask yourself, are you listening or are you reacting? Wealth in trading isn't built from catching big moves. It's built from catching clean moves. There's a difference. A big move might look impressive, but if the entry is sloppy or the breakout is unstable, you'll give back more than you gain. A clean breakout, on the other hand, is like stepping onto a train already aligned with its tracks. No shoving, no stumbling, just motion with direction. How many times have you tried to force your way into a market only to watch it reverse the moment you enter? And remember, these markets don't exist to give you money. They exist to reveal your weaknesses. If you can't wait, they'll punish your impatience. If you chase strength instead of understanding it, they'll teach you the price of recklessness. That's why price action matters so much. It's the only part of the market that doesn't lie. Indicators can be twisted, opinions can be wrong, but the movement of price is the final vote. Ever tried arguing with a market that's already made up its mind? Some traders think breakouts fail because the market is against them, but the truth is simpler. They fail because the trader entered before the price truly proved itself. Confirmation isn't a luxury, it's a necessity. Even if it costs a few ticks, that cost is cheap compared to the price of guessing. I've lost more from acting too early than I ever did from acting too late. Can you think of a time your eagerness cost you more than your caution ever did? And here's where today's lesson loops back to something we touched on before, the illusion that trading should be easy. In that earlier talk about the dangerous illusion of easy trading, I warned you that the hardest part of this game is doing the simple things consistently. Breakout trading is exactly that, simple in theory, punishing in practice. The market wants to see whether you have the discipline to wait for clarity or whether you'll throw your money at the first sign of excitement. When you trade a breakout, your job is to see where the path clears. The market doesn't hide its intentions. It shows you through higher lows pressing upward or lower highs squeezing downward. That pressure builds, forms a level, and when it breaks, the move begins. But again, the amateurs rush the beginning. Professionals wait for the first confirmation, the retest, the hold, the willingness of price to stay above the old ceiling. Isn't it interesting how the market tests your resolve right when you think you've gained certainty? A breakout trader using price action must think like a hunter, not a gambler. You prepare your entry, you measure the distance to your stop, you only risk what the structure allows, and you let the move unfold without forcing it. People ask me how I stayed patient during those long waiting periods. And I tell them, it wasn't patience, it was self-preservation. I knew that acting without confirmation meant paying tuition to the market. How much tuition have you paid so far? And once the breakout moves in your favor, it's not your job to celebrate. It's your job to manage the position. Markets move in waves, push, pull, push. If the pullbacks stay controlled, you hold. If they dip back into the old range, you reassess. That's all price action is. Observation, interpretation, discipline. Nothing mystical. Yet that simplicity is exactly why most people ignore it. Ever notice how traders love complicated tools, but hate the simplicity that requires discipline? You must also think in terms of capital preservation. Breakouts can be powerful, yes, but no single trade should matter so much that you cling to it emotionally. Wealth grows when the trader respects risk first, opportunity second. A strong breakout is worth trading only if the risk is clean. If the chart is messy, you stand aside. Standing aside is a position too. Does stepping aside ever feel harder than taking a bad trade? The mindset you bring to a breakout is the same mindset that builds financial durability. You avoid the urge to rush. You respect the market structure. You let price show you, not tell you. You don't try to force an outcome, you align with one. Wealth isn't built from excitement. It's built from consistency, and consistency is built from understanding price as the only truth that matters. When you watch a breakout form, do you see truth, or do you see what you want to see? And that brings us to the real heart of trading breakouts like a professional. It's not the entry. It's not the exit. It's the mental posture between them. The willingness to wait for the right setup, the recognition of the market's intent, the discipline to stay out when the picture isn't clear. Breakouts aren't lottery tickets, they're structural shifts in supply and demand. And if you can't read that shift with a calm mind, you'll always be a step behind those who can. So, when the next market you're watching begins to tighten, begins to show that quiet pressure, that steady determination, ask yourself, are you willing to let price prove itself before you get involved? Are you willing to ignore the noise, the tips, the opinions, and trust the chart alone? Because that's the difference between trading breakouts like a novice and trading them like someone who understands the business of speculation at its core. And as you think about that, consider how each breakout you take reflects your mindset, your discipline, your risk tolerance, your ability to read what the market is trying to say rather than what you wish it would say. When traders talk about breakouts, they often rush straight to the moment price finally bursts above a level, as if that single tick is the whole story. But the real truth, the part professionals quietly rely on, is that breakouts work best when price shows clear compression before the move. Compression is the silent buildup, the tightening of range, the narrowing of swings, the slow coiling of pressure that tells you something is forming beneath the surface. Most amateurs overlook this because it doesn't feel dramatic. There's no excitement in watching tiny candles shuffle sideways. But that calm is exactly where the future move takes shape, and if you can read it, You gain an understanding most traders never develop. Think of compression like watching a crowd gather behind a locked door. At first there's plenty of space. People mill around without purpose. But as time passes, the crowd thickens, the noise shifts, and you can feel that something is about to happen. Price does the same thing. During compression, volatility contracts. The highs aren't as high, the lows aren't as low. Each attempt to move out of the range gets pushed back gently, not violently. That gentle part is important because it shows balance. Neither side is urgently taking control yet. You can almost sense the market inhaling, preparing itself. And if you're patient enough to wait for that inhalation, the eventual exhale, the breakout, comes with more clarity and strength. The reason compression matters so much is simple. Markets move from expansion to contraction, and then back to expansion. A breakout that follows a period of contraction tends to have more fuel behind it. The traders who were indecisive finally pick a side. The orders that were resting begin to activate. The imbalance between buyers and sellers becomes strong enough to shove price out of the range. Without compression, that imbalance is usually weak. The breakout is more likely to be a fake, a quick trap for the impulsive. Have you ever noticed how the breakouts that happen out of nowhere rarely go far? In compression, the chart becomes easier to read because the noise fades. The market stops tossing big random bars around and begins communicating in a more controlled rhythm. You'll often see higher lows pressing upward into resistance, or lower highs pressing downward into support. That is price telling you where the pressure is leaning. If buyers keep stepping up earlier and earlier, they're revealing increasing confidence. If sellers keep pushing down sooner, the same logic applies in reverse. This gradual tightening gives you information that's far more valuable than any indicator. It shows which side is quietly gaining control before the move is obvious. But here's where most people get it wrong. They don't wait for the compression to mature. They see a couple small candles and assume a breakout is around the corner. Real compression is persistent. It can last days in swing trading or hours in intraday charts. It forces you to confront your own impatience. Your hand wants to act, but compression demands restraint. It's like the market is asking, "Can you wait until I'm ready?" And most traders answer, "Probably not." That's why so many get shaken out before the real move even begins. You can think of compression like a coiled spring. If you compress a spring lightly and release it, the movement is weak. But if you compress it fully, slowly, consistently, then let go, the energy release is powerful. Price behaves the same way. When ranges tighten gradually, each new candle trapping more and more tension, the breakout that follows tends to travel with more follow-through because it's fueled by that stored pressure. This is why professional traders watch the build-up more than the breakout itself. The breakout is just the trigger. The compression is the evidence. Another important part of compression is how it tests the psychology of the crowd. During this tightening, many traders get bored. They exit. They lose interest. Liquidity drops. And when liquidity drops, big players can position themselves quietly without pushing price around prematurely. The casual trader disappears just before the real move begins. By the time the breakout happens, those big players already have their positions, and price runs cleanly because resistance has thinned out. This is why truly powerful breakouts feel smooth at first. They aren't fighting crowded, chaotic order flow. To recognize compression properly, you don't need complicated tools. You just need your eyes and your ability to observe without forcing interpretation. Watch how the candles behave. Are the wicks shorter? Are the bodies smaller? Are the highs and lows gradually converging? Are impulsive spikes fading? These questions help you identify a market that's preparing. And once you see it, your job becomes incredibly simple. Wait. That's the hardest part, but also the most profitable skill you can cultivate. Anyone can click a button. Few can wait for the right moment to click it. There's also something deeply psychological about compression that reveals your own tendencies as a trader. If you find yourself getting restless during a tightening range, take that as a signal. Not from the market, from yourself. That restlessness usually leads to early entries, guessing, forcing trades, or abandoning great setups right before they come alive. The market has a way of testing your resolve before rewarding your discipline. Compression is that test. It's the market whispering, "Show me you can wait." Those who fail the test chase mediocre moves for small gains. Those who pass position themselves for clean breakouts that travel naturally. And compression isn't just about timing entries. It's also risk control. When price tightens, your stop can often be placed tighter because the structure is clearer. The market is telling you exactly where it shouldn't return if the breakout is real. That structural clarity gives you a better risk to reward profile without having to stretch your stop artificially. You're not guessing where to place it. The market shows you. But you only get that benefit if you wait for compression to finalize instead of jumping in while the range is still messy and wide. As you study charts, you'll notice a pattern across markets, time frames, and instruments. The cleanest moves nearly always begin with tightening price action. It's universal. It's timeless. And traders who learn to recognize it early gain a decisive edge, not because they predict the move, but because they understand the conditions that make the move possible. This is the foundation of breakout trading done properly, not the breakout itself, but the quiet, patient observation of the compression that precedes it, the calm before the surge, the formation of order before the release of momentum. A breakout is only as strong as its ability to stay above the level it just defeated, and that's why the retest is the moment that separates a legitimate move from a hollow illusion. When price pushes through resistance or drops below support, traders get excited. They assume that the initial burst is all the proof they need. But the truth, the part most traders learn only after being burned a few times, is that the real confirmation isn't the breakout. It's how the market behaves when it comes back to test that old level. A breakout is only valid if price can hold above the old level during the retest. And that simple principle is what keeps you on the right side of strong moves while other traders get trapped in fakes. Think about what a breakout actually represents. When price finally breaks a level that has held for days, weeks, or even months, it signals a shift in the balance of supply and demand. Buyers have gained enough conviction to push past the ceiling, or sellers have overwhelmed the buyers enough to break the floor. But a single burst of momentum doesn't prove that balance has changed permanently. Markets often surge briefly, triggered by stops and breakout traders piling in, only to reverse sharply because the underlying conviction wasn't real. The retest is where you find out whether the breakout has substance or whether it was just a temporary emotional burst. When price pulls back to retest the breakout level, it's like the market asking itself, do we belong above this line, or did we step somewhere we're not ready to stay? That moment is the true test, if the old resistance holds as support, or the old support holds as resistance. Then you have structural proof that the market truly accepted the breakout. That acceptance is what gives the move its strength. Without it, you're just trading noise. Have you ever taken a breakout trade that looked perfect in the moment, only to watch price snap back into the range as if the breakout never happened? The retest provides something else traders often overlook: clarity. When price pulls back to test the breakout level, it leaves footprints you can measure. You can see where buyers step in, how aggressively they defend the level, how clean the rejection is, and whether the candles show hesitation or confidence. You don't get that kind of information if you jump in the instant the level breaks. Trading the initial break is like taking a step in the dark. Trading the retest is stepping onto solid ground after the lights come on. One of the most revealing signs during a retest is how shallow or deep the pullback is. If price barely dips toward the old level before buyers jump in forcefully, that's a strong sign. It tells you that demand is eager even at higher prices. On the other hand, if price sinks deeply back into the old range or hesitates around the level, uncertain and messy, that's a warning. Strong trends don't hesitate like that. They move with intent. A messy retest is often the market's way of letting you know the breakout was premature. How many times have you wished you had waited just a little longer before committing to a move? Another reason the retest matters is psychological. The first breakout move is filled with emotion, fear of missing out, excitement, impulsive buying. But the retest is where the emotional traders have already taken their positions, and only the disciplined traders remain patient. That shift dramatically changes the landscape of order flow. The retest exposes who truly believes in the move. If buyers return with confidence at the retest, it shows real conviction. If they don't, it shows the breakout was fueled by emotion rather than genuine imbalance. The validity of a breakout isn't just about price hovering above the level, it's about how price behaves around it. Clean retests show clear respect for the level. Price taps it and reacts with strength. There's typically a noticeable rejection wick or a sequence of small, controlled candles followed by a decisive push away. That reaction is what lets you structure your trade cleanly. Your stop can go below the retest level because the market has already shown you where it shouldn't go if the breakout is legitimate. Without that retest, your stop is guesswork, and guesswork is expensive. Many traders think waiting for a retest means missing the move. But that's only true if you measure success by how fast you enter rather than how clearly you understand what you're entering into. The strongest trends often give beautiful retests because real conviction doesn't mind revisiting a level briefly. Weak trends don't come back. They either fail immediately or drift aimlessly. When you wait for the retest, you're aligning with strength instead of chasing motion. Isn't it better to trade strength than speed? There's also a deeper structural reason why retests matter. When a level breaks, it often triggers stop orders from traders on the wrong side of the move. That creates temporary volatility. A retest helps cleanse the excess noise. It allows the market to stabilize around the new level before continuing. That stabilization is what builds the foundation for sustained movement. Without it, you're standing on shaky ground. Think of it like building a house. You don't trust the structure until the foundation is tested. In uptrends, the best retests happen when former resistance turns into new support with clean, tight reactions. In downtrends, the reverse is true. Former support becomes new resistance. These transitions are some of the most reliable signals in trading because they represent real shifts in behavior. Once buyers or sellers prove they can defend that level, the breakout is no longer just a breakout. It becomes a structural shift in the market's psychology. And even when retests happen quickly, sometimes within a few candles, the principle is the same. What matters isn't the duration of the retest, it's the quality of the reaction. Fast or slow, loud or quiet, the market will show you its intention through how it responds to the level it just left behind. That response is your anchor, your confirmation, your green light to act responsibly rather than impulsively. This is why professional traders treat the retest as part of the breakout sequence, not an optional event. It's the moment that reveals whether the breakout deserves your capital or whether it's another trap waiting to spring. It's the point where patience pays and impulse loses, where structure becomes visible, where risk becomes manageable, and where the market tells the truth more clearly than at any other moment in the move. When traders first start looking at breakouts, they tend to get hypnotized by speed. A quick surge above resistance looks exciting, dramatic, full of promise. But the truth is almost the opposite of what your instincts tell you. Breakouts that look exciting are usually the weakest ones, because excitement comes from chaos, fast candles, emotional traders, sudden spikes in volatility. Clean structure, on the other hand, is quiet, it's controlled, it's orderly. And that's why clean structure matters far more than speed or excitement when you're trying to confirm a breakout. A breakout with clean structure looks almost boring at first, and that's exactly why it works. It doesn't yank price violently across the chart. It doesn't leave wide, erratic wicks. It doesn't behave like a firework popping off for show. Instead, it behaves like a determined walker. Steady steps, clear direction, no unnecessary motion. When you watch these kinds of breaks, you can feel the confidence behind them. Buyers or sellers aren't scrambling. They're deliberate. They don't need drama to prove their conviction. Clean structure before a breakout usually appears in the form of tighter ranges, smoother highs and lows, and a market that feels organized instead of emotional. The candles compress, the noise fades, and the chart almost seems to steady itself before the move. When price finally breaks, that same orderliness continues. The breakout candle often isn't enormous, it's simply decisive. It closes beyond the level with clarity instead of panic. That clarity is what gives the move its staying power. Speed, however, is deceptive. A fast breakout can be driven by stop hunts, news spikes, or impulsive traders jumping into the move at the same moment. These bursts often look impressive but lack foundation. When the move is driven by emotion instead of structure, it tends to spike and collapse just as quickly. You've probably seen it. Price explodes above resistance, retail traders jump in late, then the market snaps back and erases the whole candle. Exciting, yes. Tradable, not safely. The stronger breakouts come from markets that have already shown you exactly how they behave leading up to the move. You want to see clean higher lows pressing into resistance, or clean lower highs pressing into support. That kind of structure tells you where the pressure is building. It tells you that the market is aligned, not chaotic. When pressure builds in an organized way, the breakout carries the weight of that organization. The market isn't reacting, it's transitioning. Clean structure also helps you manage your risk more effectively. When the chart is neat and orderly before the breakout, you know exactly where the market shouldn't return if the breakout is real. The swings are clear. The levels are defined. The behavior makes sense. That clarity lets you place your stop with precision instead of guessing or using an arbitrary number. You're not fighting randomness. You're aligning with structure. Excitement gives you nothing but an adrenaline rush. Structural clarity gives you data, and data is what keeps you from making mistakes that drain your capital. Think about the last time you chased a breakout because the candle looked strong and fast. Did it hold, or did it snap back because the move wasn't supported by anything meaningful underneath? Traders who focus on excitement tend to believe that the market will reward aggression. Traders who focus on structure understand that the market rewards alignment. A breakout built on clean structure is less about energy and more about pressure. Pressure isn't loud, it's steady. It builds quietly, almost invisibly, until the breakout becomes the natural next step, rather than a sudden event. Another reason clean structure matters more than excitement is that it reduces false signals. Markets love to tease impatient traders with sudden spikes. These spikes trigger breakout orders, sweep liquidity, and then fade because they weren't backed by true conviction. Clean structure filters out that noise. When a market has been moving with discipline before the breakout, the likelihood of the breakout being a trap decreases dramatically. The market is showing consistency, and consistency is the backbone of sustainable moves. Clean structure also reveals something subtle but invaluable intention. A market preparing for a legitimate breakout often feels like it's leaning on the level, pressing gently but persistently. It's like watching a door begin to bend under pressure. When the door finally breaks, it doesn't slam open violently. It simply gives way. That's what a strong breakout looks like. It doesn't shock you. It makes sense. And this concept ties deeply into the psychology of trading. When you rely on excitement, you're trading your emotions. When you rely on structure, you're trading the market's behavior. The shift is profound. Structure grounds you. It forces you to observe instead of react. It encourages patience. It demands discipline. Those qualities matter far more than the thrill of catching a fast candle. Clean structure also helps you stay calm during the breakout itself. Because the setup was orderly, the breakout tends to move in an orderly fashion as well. The pullbacks are controlled. The reactions make sense. The trend behaves in a way that allows you to manage your trade without panic. You're working with the market, not fighting against it. And perhaps the most important part of clean structure is that it's repeatable. Exciting breakouts can't be relied upon because they come from unpredictable conditions. But structured breakouts follow patterns rooted in supply and demand, and those patterns appear again and again across markets, time frames, and environments. They allow you to refine your strategy, build consistency, and trust your process over time. A breakout supported by clean structure isn't just a move on the chart. It's a message. It tells you the market is organized, confident, and ready to move with purpose. And traders who learn to read that message find themselves trading fewer fake outs, taking higher, quality setups, and aligning with moves that have the strength to continue rather than collapse. A breakout always looks most tempting at the very first push. That moment when price finally leaps above resistance or dips below support feels like an invitation, almost like the market is whispering, "Hurry, get in before it's too late." But that whisper isn't the market speaking to you. It's your own fear of missing out. And that fear is why so many traders jump in at the wrong moment. The more experienced trader knows better. The more experienced trader understands a simple but powerful truth. Avoid entering at the first push. Wait for the market to prove strength. The initial breakout is where emotions are loudest. It's where traders who have been watching the level for days suddenly get excited. It's where stops get triggered, where impulsive orders flood in, and where the chart can become temporarily unstable.